I'm Ben Stahman, the Director of Utah State University's Gift Planning Office. It's my pleasure to welcome you to this online workshop. As Utah's land-grant university, our unique mission is to serve the public through learning, discovery, and engagement. We're the only higher education institution to have a physical presence in every one of Utah's counties. Our statewide campuses and extension offices have pioneered distance learning in Utah for decades. Today's session belongs to that tradition. During our webinar, participants' video and audio are automatically disabled, so neither the presenter nor the other participants can see or hear you. The chat feature at the bottom of your screen allows you to comment or ask questions. What you type is only visible to the host, not to the other participants. If the presenter doesn't answer your question, one of us will reach out to you afterward with an answer. Our presenter, Adam Jones, is an accredited investment fiduciary and senior advisor with Keeler Thomas Management of Orem, Utah, which provides financial planning, investment management, retirement planning, and fiduciary services to individuals and corporations. Adam is a seasoned advisor who presents on financial topics at numerous venues throughout Utah. He's passionate about educating and empowering families as they navigate growing their assets, protecting their wealth, and planning their legacy. This and other webinars in this series on important financial topics are presented by community members across the state who serve on the university's Gift Planning Professional Advisory Board. This board is a group of seasoned professionals with expertise in estate planning, taxation, personal finance, and investment management. They help our office elevate USU through donor engagement and philanthropy. To all of you participating, thank you for engaging with us, and we hope you learn and discover something valuable today.
Hi everyone, I'm Adam Jones, Senior Advisor at Keeler Thomas. Today we're going to be talking about Social Security. Before we begin, I want to pose a question to you and want you to think about this. In life, would you rather be early or delayed? And would you rather receive a bonus or a penalty? Think about that as it relates to you just in your life in general. We're going to be coming back to that topic later on in the workshop, but for now chew on that for a minute and then we'll come back to that. So, why are we talking about Social Security? Well, the main reason is there's a bit of a problem, and the problem is that there's been poor decisions when it comes to claiming Social Security benefits. A lot of baby boomers and people who are already claiming their Social Security have whether it's due to misinformation or not knowing all the rules, have made some poor decisions. So today we want to provide some education and provide you with some tools and understand the rules so that you can make some good decisions when it comes to claiming your Social Security benefit. Okay? Because of these poor decisions, it's made it difficult for our job to help people when they've already set in stone those bad decisions when it comes to Social Security. So the planning becomes even more important and critical for retirement when that's happened. So we want to get ahead of the curve, make some good planning choices, and stick to something that can set you up to live the kind of lifestyle that you want in retirement because you've made a good decision about Social Security. All right, let's lay some of the groundwork here for Social Security and some important things to know. First off, you need to know that there are many claiming options. It's conceivable that a couple could have several hundred, if not thousands, of different claiming options available to them. So we want to understand what's best for our situation. There is no one-size-fits-all when it comes to Social Security and your claiming options. All right. Second, you need to understand that there are far-reaching consequences to your decisions. Okay, and those consequences can affect both spouses. So if you're married, your decisions that you make about Social Security can affect your surviving spouse in the event of a death. And we'll be talking about that at length today. So it's important to understand those things. We also want to clear up some information that the system is not bankrupt. Okay. We'll talk about the health of Social Security and clear up a few things. You've probably had a family member or a friend that has benefited from Social Security, but it's also important to know that they are not experts. Okay, so I want to make a couple of promises. We feel like after today's workshop that you will be able to make smarter decisions when it comes to Social Security. You'll be well equipped with the tools necessary to do that, and that you can have some confidence about those decisions. The second promise is there's no selling happening today. It's purely educational. We want to be a resource for you so that you can make good decisions. Again, it comes back to that planning. Met with a lot of people who've made poor decisions, and it creates a real problem for them. So we want to help you get a plan in place for Social Security, which is only part of the planning puzzle. But we feel like with today's workshop, you'll be well equipped to do that. As always with our workshops, we're offering a complimentary consultation. So at your convenience, we'd be happy to sit down with you and answer any of your questions. We have no agenda, nothing to sell. We are offering a Social Security analysis where we can plug in your information and help you determine what's your best strategy for claiming your Social Security benefits, as well as a retirement gap analysis where with some additional information we can help you understand where you're at now, where you want to be at retirement, and fill in the gap and help you understand what you need to be doing between now and then. What we're seeing is that baby boomers want to know, will Social Security be there for you? You've been told for years that the system is going broke, but now that it's almost your turn to collect, is that really true? You also want to know how much you can expect to receive, and before you can retire, you've got to know how you're going to support yourself. That means doing a budget, lining up your income, and knowing how much you can expect to receive from all your sources. Social Security, because it is a relatively known quantity, represents the foundation of that plan. You're also probably asking when you should apply for Social Security. You may have heard that if you apply early, your benefit will be lower than if you apply later. But is it worth missing out on all those extra checks to have a higher benefit later on? We're going to shed some light on this important question later. Something your parents probably never asked is how is it possible to maximize your benefits? There's absolutely nothing wrong with using the Social Security rules to your advantage. Today we're going to talk about 5 ways you can maximize your Social Security benefits simply by knowing the rules and making smart decisions. And finally, you're wondering if Social Security will be enough to live on in retirement. You probably already know the answer to this. Social Security represents about 40% of the average retiree's total income. But by coordinating Social Security with the rest of your retirement income plan, you could pursue a comfortable, worry-free retirement. Most people tend to minimize the value of Social Security. If they believe they are likely to get something back from the system at all, they think it will be a minimal amount, not really enough to count on. But Social Security is far more valuable than most people realize. Here's a snapshot of a chart of the Social Security analysis that we are going to offer to everyone who's participating in this workshop. It can compare several different scenarios for you to help you understand how you can maximize Social Security for your situation. One of the things we love most about this analysis is that it gives us a year-by-year look at what Social Security will be providing both on a monthly basis and an annual basis, as well as a cumulative amount that you could receive from Social Security. In this example here, if this couple lived into their 90s, the total amount they will receive from Social Security is just under $2 million. This is why we say the decision that you make about Social Security is one of the most important, or if not the most important decision when it comes to retirement planning. One of the most common questions when it comes to Social Security is, will Social Security be there for me? And so to address that, let's review a little bit of information about Social Security. Social Security originally was called OASDI, the Old Age Survivor Disability Income. Okay? No one was too fond of the old age part, so that's why we typically just call it Social Security. And this is a trust fund. Okay. Currently, the trust fund has about $2.9 trillion in the trust fund. In 2018, the trust fund had income, meaning the revenue collected from taxing for Social Security purposes, of $1.03 trillion. And it had expenditures, meaning what it paid out, of $1 trillion. Okay, so it's continuing to grow. However, current forecasts show that if we make no changes to Social Security, that in the year 2035, we would have to start making cuts to Social Security benefits. Now, there's lots of ways we can avoid that, and we need the government to agree on something and get something passed. But some of the proposals to fix or shore up Social Security are the following. Currently, we have something called max earnings that are subject to Social Security tax, and that is about $132,000. So if you make more than $132,000, only the dollars up to $132,000 are taxed for Social Security purposes. So by raising the max earnings threshold, we could receive more dollars, more income for the trust fund. Another proposal would be to raise the full retirement age, FRA, we'll be using that phrase today, to something higher. So currently, if you were born between 1943 and 1954, your full retirement age is 66. If you were born between 1955 and 1959, your full retirement age is 66 and some months. Okay? And if you were born in 1960 or later, full retirement age is 67. All right. So if you happen to be in this weird category here, born between 55 and 59, the months work out for 2 months for each of those years. So if you're born in 1955, full retirement age is 66 and 2 months. In 1956, it would be 66 and 4 months. 1957, 66 and 6 months, and so on, until we get to 1960 if you're born then or after. 67 is your full retirement age. So currently, that's where your full retirement age is, and the proposal is to raise these ages for someone born certainly after this time period. That way they'll be paying into the system longer, delaying when they actually start taking their income from Social Security. Another proposal would be to lower benefits for future retirees. Okay, that's not a super popular idea, but it's something that the younger generation could plan for and react to. And then the last one would be to reduce or cap something called COLAs, which are cost of living adjustments. So each year Social Security looks at what's happening with inflation and prices and can give Social Security recipients an increase in their benefits so that they can keep up with those rising costs. Okay? And that amount has averaged over the last 30 or 40 years somewhere close to 4%. It's been 0 some years, it's been as high as 5 in some years, but it fluctuates, and the idea here would be to reduce or cap that at a lower rate to control the costs. The main thing to remember is that for the baby boomers, so our 55 and older crowd, that all these proposals would not affect this group of people. Okay, it would certainly affect the younger generation. So the bottom line is, if you're close to or planning for Social Security, don't worry so much about whether it's going to be there for you. Okay, be happy. We can count on Social Security for this group of individuals. It should be part of your plan, and you should make good choices about it, and we should utilize the tools available to us so that we can get the most out of the system. So, after thinking about that, you might be rightfully saying, what's a clearer way to think about Social Security? Well, here's a straightforward definition. Social Security is inflation-protected income that you can't outlive. Even after your death, your benefit could continue in the form of survivor benefits, as we'll see later. Your premium or tax is listed on your paycheck receipt under FICA, which stands for Federal Insurance Contribution Act. You and your employers have paid that premium in every paycheck, so you want to be smart about how and when to collect this earned benefit. Let's look at its various features. The next natural question is, how much can I plan to receive from Social Security? So let's talk about how much. Okay, that depends on a couple of things. First, it depends on how much you've earned over your working career. And second, it depends on what age you apply for your benefit. Okay, let's review how they calculate Social Security. It's important that we don't get bogged down in the complexity of the calculation, but I think it's important to understand the basic rules for calculating Social Security benefit. So what they do is at age 62, they tally up all of your earnings, all of the years, and index them for inflation. Okay, so they take the highest 35 years of work history. First of all, in order to qualify for a Social Security benefit, you have to have what's called 40 work credits or quarters. There's 4 quarters per year. So after about 10 years worth of work, you would qualify for that. That first checkpoint is that you've had 40 credits. All right. So the first part of the calculation is at 62 is taking the highest 35 years of work history. They then divide it by the number of months and determine something called the AIME, which is the average index monthly earnings. Okay. Which then, in this part where it gets a little tricky and is just informational only, they apply this AIME to something called a bend point, and they do 3 bend points, which are dollar amounts. Okay, and that gets them to the final part of the calculation, which gives them the PIA. Okay, the primary insurance amount. This is the amount you will get at your full retirement. Okay, we reviewed that somewhere between 66 and 67. All right, so what if I don't have 35 years of work history? What if I only have 30 years? Well, then there's going to be 5 years that count as a 0, which would bring down my average and affect my primary insurance amount. And if I have more than 35 years, again, they'll just take the highest 35 years and run the calculation. The other thing that can affect the amount in the calculation are the annual cost of living adjustments. Okay, when we talked about those. So this is the basic calculation for determining what your PIA or your primary insurance amount will be at your full retirement age. Some of you may be thinking, well, it's good to know how they calculate benefits, but why shouldn't I claim early at 62 instead of delaying to full retirement age or even 70? It's a good question, and it's also where some people start to get into trouble. That's because your monthly benefit will be reduced if you claim early. It may also be reduced by taxes, and Medicare premiums will also be deducted, and benefits could be withheld if you continue to work. What this means is that even when you maximize your claiming strategy, something we're glad to help you with, the amount you actually receive will be smaller in reality because of the taxes and parts of your Medicare coverage. All right, now we move on to the question of when should I apply? Okay. Well, there's a few things you want to take into consideration before we answer the question of when. First, we want to know what our health status is. Okay. Which leads into when do we think we're going to die? Or life expectancy. Okay. If you knew the answer to that, that would make this decision a lot easier. It'd probably make a lot of other things easier, or maybe harder. But it's important to know, based off what the tables tell us of when our life expectancy is, what our family history might be, how long did mom and dad live, or grandma and grandpa, what's my own health status, what do I view as the likely time that I might die. I know it's not fun to think about, but it's important consideration, and also it's important to take that in consideration for your spouse or who will be your survivor. Okay, there's a big age gap between you, and you're going to most likely die before your spouse. What you leave behind to them as far as a Social Security benefit in the form of survivor benefits is very important, and there's strategies to take into consideration. We'll be getting into that, but your survivor needs are just as important as your own health status and life expectancy. We need to consider that for both spouses. We need to take into consideration your income needs. Okay, we need to know what other resources we have coming in, how Social Security will affect that, what we need to live our lifestyle and to feel comfortable. Are we going to continue to work? That will affect our decision for when we apply for Social Security. And so these are some of the basic things to consider when we're talking about when should we apply. So next, let's look at what happens when we apply at different ages to our Social Security benefit. Okay, first, let me just get this right off the bat. A lot of people ask the question, will Social Security be enough for me to live on? You probably already know the answer, but probably not. Okay, so again, the planning becomes very critical and very important in knowing what resources we have and making good decisions about Social Security so that we can have a comfortable lifestyle. All right, so what happens if we claim at different ages? Okay, so earlier we talked about the FRA, okay, the full retirement age, and again that's somewhere between 66 and 67. Okay, what we're going to look at right now with numbers and how it affects when we apply is we're going to assume that your full retirement age is 66. Okay, so let's say we decide to apply at age 62, which is early. Remember, one of the first rules we learn about Social Security is that when we apply early, we're locking in a lower or reduced amount. Okay, and at age 62, for someone whose full retirement age is 66, they will get a 25% reduction in their benefit, which means they will only get 75% of their PIA. Okay, at age 63, they would get 80% of their PIA. At 64, they would get 86.7%. At 65, they would get 93.3%. Okay. Now, if your full retirement age is 67, these percentages are even less because there's more time to your full retirement age. All right. So just remember that any time we apply it early, we're getting a reduced amount, and that amount goes up every year. In fact, it goes up every month. They redo the calculation. So what happens if we delay taking our benefit to a later age? So we obviously know that at 66, we're going to get 100% of our PIA. But what happens if we wait until age 67? Well, in the case of someone whose full retirement age is 66, they would get 108% of their PIA. Okay, and then from then on it goes up by 8% every year, so it would be 116 at 68. At 69 it would be 124%, and at age 70, which is the latest time at which you can claim a Social Security benefit, it would be 132%. Okay, now these 8% increases are called delayed credits. Okay, so for applying for your benefit, you get an 8% increase every year past full retirement if your full retirement age is 66. It's a little bit less if your full retirement age is 67. But this is a great way to understand the benefits of delaying your Social Security to later ages. Okay, now generally speaking, it does help people in the planning to delay taking their benefits. But like I said, Social Security is not a one-size-fits-all. No two people are the same when it comes. Everyone's lifestyle and their health situation is different. So it's okay to claim a benefit early if it fits your situation. And that's why we'd like to run that Social Security analysis for you to help you to determine, not only for you, but for you and a spouse, when the best time to apply for your benefit is. I'm guessing you're probably not too interested in calculating by hand your AIME and your PIA and the reductions and credits for early or late filing, or the annual cost of living adjustments that could raise your benefit in the future. But there are ways you can easily find out approximately the amount of benefits you can expect to receive. One way is you can refer to your annual Social Security statement. These are now available online at www.socialsecurity.gov/mystatement. You will need to set up an account by answering a number of security questions. Another option you can use is the retirement estimator on the Social Security website. This calculator taps into your specific earnings history after you enter your personal identifying information, including your birth date, Social Security number, and your mother's maiden name. Don't worry, the site is very secure. Please note that the annual statement and the retirement estimator do not factor in cost of living adjustments into your age 70 benefit. This means your actual benefit will be likely much higher than they indicate. But our calculators do adjust for cost of living adjustments, so if you know your PIA, we can help you project your future benefits. That's part of what we'll do for you. The obvious advantage to delaying benefits is that your monthly benefit will be higher. A baby boomer who has a primary insurance amount of $2,800 and full retirement age of 67 would receive $1,960 per month if they applied at age 62, but $3,472 if they waited until age 70. The difference becomes even more dramatic if we multiply these amounts by a 2.6% annual cost of living adjustment. If cost of living adjustments average 2.6% over the next 8 years, the age 70 benefit jumps to $4,263. It might be hard to pass up Social Security checks when you can start receiving them as early as age 62. But if you live a long time, you will be forever glad you waited. As you can see, the longer you live, the more income you will have by waiting until age 70 to apply. You might be wondering, how can I maximize my benefits? Let's look at a couple of strategies. The first thing you can do while you still have time is to improve your earnings record. Check your annual statement to make sure your earnings record is accurate. Mistakes are rare because the earnings on file at Social Security were reported by employers when they submitted your Social Security taxes, but mistakes can happen, especially for self-employed individuals. The next thing is to consider how you might be able to improve your earnings record. If you do not have 35 years of earnings, you can work a few more years so they will not be filled in with zeros. If you had several years of low earnings early in your career, can you work a few more years now while you're in your peak earning years, so those low earning years will be replaced with the high ones? Even if you start receiving Social Security but continue to work, your earnings record will be updated. However, it's important to know that if you start receiving Social Security before reaching full retirement age and you earn over a certain threshold, $1 of your benefits will be withheld for every $2 over that threshold. Applying for the benefits at the optimal time is the best way to maximize your Social Security benefit. The main reason for delaying benefits is because that it will result in the highest lifetime benefit for you and your survivor. But there is no one-size-fits-all answer to this question. The important thing is that you apply at the time that is optimal for you. All right, let's talk about taxes and Social Security. Okay, if you're going to continue to work and start collecting Social Security, there's something you need to be aware of that's called the annual earnings test. Okay, this only applies if you're collecting a benefit before your full retirement age. Okay, that's key to remember. If you are 66 or 67, somewhere in between, and older, you can continue to work, and applying for Social Security will not negatively impact your Social Security benefits. Okay, but if you are below your full retirement age, meaning you're somewhere between 62 up to 67, applying early while you're still working can have an impact on your Social Security benefit, and that's where this test comes in. So the way the calculation works is that for every dollar, there's a dollar withheld for every $2 over the threshold. And in 2020, the threshold is $18,240. Okay, so for every $2 over that limit, they take a dollar away from your Social Security check. Okay, this gets adjusted when you get to full retirement age, so that your benefit will be bumped back up to as if you had applied at full retirement age. But that can negatively impact what your benefit was, and in some cases, if you make too much, it will completely wipe out what your benefit might be, and you will have filed at an early age for no reason. Okay. Sometimes this happens though when someone loses a job, say at 62, they need income, so they apply for their Social Security benefit, and then a time goes by and then they get a new job, but they're on Social Security, and this earnings test will come into play. So if you make less than that threshold, you don't need to worry about this. Just as an example, let's say an individual earned $23,240 during the year. That's $5,000 over the limit. So they would take away $2,500 in 2020 from your Social Security checks. Okay, so there's an offset there. So this is important to remember. If you're before full retirement age and you start Social Security and you're still working, you'll be subject to this annual earnings test. Okay, what about our actual benefits? Are they subject to tax? Okay, the way that works is depend on something called your provisional income. Okay, and the calculation for provisional income is they take your adjusted gross income, they add back to that half of what you will receive from Social Security, all right, so half of your Social Security benefit, plus they add what they call tax exempt interest. Okay, that equals this provisional income. Tax exempt interest would be things like if you own a municipal bond and you're receiving tax exempt interest from that. This calculation provides provisional income. If you're married, filing jointly, and that provisional income is under $32,000, you pay 0% tax on your Social Security benefit. Okay, if it's between 32 and 44,000, up to 50% of the benefit is subject to tax. Now you're not paying a 50% tax rate. It's only 50% of the Social Security income you're receiving is subject to tax. All right, so they'll add that to your other income to determine what tax bracket you're in, and the Social Security is only subject. The Social Security portion is only subject to 50%. If you have more than 44,000, only 85% of your Social Security benefit will be subject to tax. Okay, if you're filing as a single person, these dollar amounts are a little bit lower, but this is how tax is involved with Social Security benefits. So it's important to know if you're going to continue to work, how that'll impact your benefits, and then how much of your benefit will be subject to tax. This is important because we want to know the actual dollar amount that's going to end up in our pocket for our cash flow and spending needs. Remember that if you are 65 or older and enrolled in Medicare, your Part B monthly premiums will be deducted from your Social Security check. As you can see here, if you claim early, your Medicare Part B will always eat up a larger percentage of your benefit than if you wait until full retirement age or later to claim your Social Security benefit. The when to apply question is very complex and really requires a customized analysis. But here are a few points to remember. If you apply early, your benefits start out at some fraction of your PIA, 75% or 80% or whatever, and remains at that percentage for the rest of your life. It does not go up to 100% when you reach full retirement age. Cost of living adjustments magnify the impact of early or delayed retirement because the annual cost of living adjustments is applied to the either lower or higher amount. This causes the disparity to increase with each passing year. Your benefits may be taxed and further reduced by Medicare premiums. Don't let the earnings test discourage you from working. It can be helpful for some. And finally, delaying benefits may give the surviving spouse more income. That's an important point to consider, especially if you're thinking something like this. I'm not going to live long, so why shouldn't I just claim my benefit while I can? The typical answer to this question is, for couples, you should always maximize the higher earner's benefit to protect the surviving spouse, who will step into that benefit after the higher earner dies. High-earning spouses are therefore encouraged to delay benefits to age 70, because that will give their spouses the highest benefit after they die. All right, let's talk about spousal benefits. Did you know that if you're married and your spouse never worked and stayed at home to raise the kids, or did not qualify for a benefit because they had less than the 40 credits, they are still eligible for a spousal benefit based off of the working spouse's PIA, off their work record. Okay, so the way it works is that spousal benefits are equal to 1/2 or 50% of the primary worker's benefit. Their PIA, the amount they will receive at full retirement. So a spouse can claim a benefit that's equal to half of their working spouse's benefit. All right. This provides a lot of opportunity for planning, as well as income that people didn't know that they might have been eligible for. So let's say, for example, we have a primary worker, his name is John. His PIA is $2,000, and his wife Jane worked, but she earned a little bit less, and her primary insurance amount is $800 based off her work history. So if Jane started her benefit at her full retirement age, she would get half or 50% of John's benefit, which is $1,000, which is more than her own benefit. So this is a way of increasing the income for the family. Now it's important to remember that this is at full retirement. Again, if we claim early, we're going to get a reduced amount. Okay, so some of the rules that are applied here are the primary worker has to have applied for their own benefit. So in this example, John would have had to apply for his own benefit in order for Jane to receive her spousal benefit. Okay, and the spouse who's claiming this spousal benefit must be at least 62 or older to qualify. Again, remember, if we apply it early, we're getting a reduced amount. Now, with our own benefit, in John's example, if he delays taking his benefit, he can earn those delayed credits. When it comes to a spousal benefit, there are no delayed credits, which means Jane's benefit would not get any higher than $1,000 or at age 66 if that was her full retirement age. It would not get bigger after that point. She does not earn delayed credits. Okay, so some people will falsely say, I'm going to wait and get those delayed credits as a spouse, but those do not exist for the spousal benefit. Okay, so if you need help figuring this out, let us talk, and we can run that analysis for you to determine when the best time to do that is. So it's important that we coordinate benefits so that we can maximize benefits. Okay. For example, a couple of things to consider. if the lower earning spouse has a benefit that is more than 50%, so in this case, let's say Jane's benefit was $1,200. In that case, if the lower earning spouse has a higher benefit than 50% of the PIA of the primary worker, it's probably a good idea for that for both of them to delay. This will help maximize the income for this family. Okay, again, it's not a one-size-fits-all. This is assuming they are going to live a long, healthy life past that break-even point, and that will provide some income for them. Another option is to do something called the restricted application. And it's important to remember here that for this to work, you have to have been born before 1954. What the restricted application says is that, let's say both these individuals reach full retirement age, they're 66. One of them can apply for their own benefit. Let's say, for example, both their benefits were $2,000. One can apply for their benefit of $2,000. The other can file a restricted application. They're restricting their application to their spousal benefit, so they would get $1,000. And they're leaving their own benefit alone, which they're eligible for, to grow until age 70, when they can switch to that benefit, which will now be much higher. This is a great way of maximizing the benefit and providing a lot more income. A couple years ago, there was a bipartisan budget act that got rid of that rule, but kept it grandfathered for anyone born before 1954. So if you have questions or that applies to you, let's talk about that, because that's important. What if the case is that the lower earner has less than 50% of the PIA? In that case, it's probably a good idea for the lower earner to go ahead and apply early, even as early as age 62, and start income for the family, and the higher earner would delay their benefit till age 70. Again, if their health looks good and they can afford to do that, that way we can increase or maximize the benefit for that family. So lots of different things to consider, different strategies. We want to coordinate the benefits so that we can maximize them. Our tool and our analysis will be able to do that for you, and we'd be more than happy to do that if we can gather some information from you. We'll be talking about the analysis a little bit later on. But as you can see, spousal benefits play a huge part into the decision process for where the income's coming from and how much. I want to remind you I will be happy to run a series of maximization scenarios for you to help you identify your best claiming strategy, whether you're single, married, divorced, or widowed. So let's continue as we look at how survivor benefits work, since we just focused on maximizing one benefit for that situation, especially since you may be thinking, well, I'm widowed or divorced, so how does that impact my Social Security strategy? If you're widowed or divorced, you may be eligible for survivor benefits, divorce survivor benefits, or divorce spouse benefits. By coordinating these benefits with your own record, you may be able to increase your total benefits. But first, let's look at the basic survivor benefit a spouse would receive, hopefully after maximizing the other spouse's benefit. All right, let's talk about survivor benefits. So anytime we talk about survivor benefits, it means there's been a death. You don't want to confuse spousal benefits with survivor benefits. Okay? So a couple important things to remember. Number one is the age which the deceased person claimed their benefit. Okay? If they claimed before full retirement age, the benefit is either 82.5% of the PIA or the original benefit, whichever is higher. So if the deceased person claimed early at 62, the survivor would get a little bit of a bump by getting 82.5%. If they claimed later than about age 64, then they would get this original benefit because it would be higher. If they claimed after full retirement age, then they would just get the original benefit, and it would also include delayed credits. Those delayed credits. So if they died when they were later in life, 67, 68, 69, the survivor would get all that delayed credits. Okay. Second thing to know is the age at which the survivor claims. Okay, so if they claim before FRA, they're going to get a reduced amount. That's rule number 1 with Social Security. So while they might be getting 82.5% of the PIA, it'll be further reduced if they're claiming before the survivor's own full retirement age. And then after full retirement age, they would just get that original amount that the deceased had. If both have already claimed and then the higher earner dies, the higher benefit continues to the surviving spouse. For example, if a husband was getting $2,000 a month and the wife was getting $1,000 a month and the husband died, instead of getting $3,000 a month as a couple, she would continue with the higher benefit, which is $2,000 a month. That's the survivor benefit. Okay. A couple of rules to remember also. You have to have been married for at least 9 months at the date of death. Okay. The earliest you can actually apply for a survivor benefit is age 60. Okay, and even younger if you're disabled. But generally, we think of age 62 as the earliest to apply for benefits. That's true with your own benefit or a spousal benefit. But for survivor benefits, you can apply as early as age 60. If you get remarried, the survivor benefit is not available if you remarry before age 60. Okay, kind of a wrinkle in this. If that marriage, if you got married again and that ended, then you would be able to go back and collect this original survivor benefit. So there's lots of unique rules to this, and it's important to know. In the case of a divorced spouse survivor benefit, okay, so there was a marriage, it had to have lasted 10 years, and you've not remarried, you'd be eligible for a divorced spouse survivor benefit. So certainly if you have questions about this, let's sit down and go over this, because there are some unique rules as it relates to survivor benefits and divorce situations or remarriage situations. All right, let's talk about divorced spouse benefits. Okay, so divorced spouse benefits are actually the same as spousal benefits. Oops. If a couple of things have happened. First off, the marriage had to have lasted 10 years. Okay, that's rule number 1. Second, if you're receiving benefits currently and are unmarried, they are the same as spousal benefits. So currently receiving and unmarried. Okay. if your ex is at least the ex-spouse who you're claiming benefits on has to be at least 62 years or older. Okay, so you wouldn't be able to claim a divorced spouse benefit off your ex-spouse in their working record until they are 62 or older. If the divorce was more than 2 years ago, then you do not wait. You don't need to wait for the ex-spouse to have filed. Okay. If it was within 2 years, then you would need to wait until the ex-spouse filed. All right. So, a couple things to remember or to know about. It's possible that more than one ex-spouse can claim off one individual. Okay. For example, we know that marriage has to have lasted 10 years. So let's say a gentleman was married for 10 years, got divorced, then married another person for another 10 years and got divorced. Both those ex-spouses could claim off that one individual as long as they did not remarry and these other rules fell into place. At 62, they'd be able to claim. All right, it's rare, but it's possible and it can happen. Okay, but remember, if you get remarried, the benefits will stop. You'd be able to claim off a new spouse, though, if you did get married, as long as that marriage had been in place for a while. So you might be saying to yourself, "Golly, this is getting kind of complicated." That's where we're happy to sit down with you and help you figure this all out, because it does become complicated and there's lots of different rules, and you can get tripped up pretty easily. You may have heard of the term behavioral finance. Okay, this is the study of the influence psychology has on investors. If we go back to our original comment about the thing I posed to you about, would you rather be early in life or delayed or receive a penalty or a bonus, I think most people would say they'd rather be early and they'd rather receive a bonus. They don't want to be delayed or have a penalty. But when it comes to Social Security, it's kind of the opposite. That's why I wanted you to get thinking about this. I don't think the government set it up this way, but in Social Security terms, early means a penalty and delayed means a bonus. Okay, so I think it's interesting for us to think about that and start to equate in our mind and know that going into Social Security, early means a penalty, delayed means a bonus. Okay, but like I've said several times, there's no one size fits all when it comes to Social Security. We need to come up with a strategy that's best for our situation. We have to make some assumptions about how long we're going to live and what we're going to do for our survivor benefits for those we leave behind, and how it works with our overall income sources and our retirement planning. So these are the rules as it relates to divorced spouse benefits. If you have questions specifically about that, get in contact with us and we'll be happy to help you answer those. This is what we started with as our core challenge. People are hurting their retirements by making terrible, costly decisions about Social Security. We then went through 4 insights designed to help us understand the problem and develop a belief in a solution that might work. In brief, these insights were: 1. Social Security offers inflation-protected income for life, including survivor benefits. 2. Your monthly benefit will be reduced if you claim early. 3. Couples should always maximize the higher earner's benefit for the surviving spouse. 4. If you're widowed or divorced, you may be eligible for benefits that can increase your check. So, what's the solution? Well, everyone should take advantage of our complimentary Social Security analysis. Okay. You'll be receiving an email with a link to our website where you can complete some information to give us what we need in order to do that analysis. Like I said, it's complimentary. We're to have nothing to sell. It's a way for you to figure out how you can maximize your claiming strategies for Social Security. Okay. It's important that we consider Social Security in our overall retirement plan. Remember, like I said, Social Security is only one puzzle piece to your overall plan, retirement plan, that is a giant puzzle. And then we need to figure it out and sit down and consider things like pensions that you might have, IRAs, 401ks, whether or not you're going to continue to work, what the impact of required minimum distributions, which now start at age 72, how that will impact how Social Security is involved in all these decisions. We need to look at the bigger picture, what our investment portfolio looks like. And so let us help you figure that out by doing the Social Security analysis for you. If you call the Social Security office, there's some things they can do for you and things they can't do for you. They can help you estimate your benefit and tell you what you're entitled to, but they can't help you project what your future benefits will be or help you to strategize about what claiming options you should pursue. So you have questions. When should I apply? What happens if I keep working? What happens if I've already applied? What are my options? You have some options there. How will this affect my spouse? We have the answers. We can help you. Again, we have nothing to sell. We want to help you make good choices. Social Security is too important just for guesswork or to say, oh, I'm 62, I guess I'm eligible and I'll collect. Okay? We want to make sure you're making good, smart, educated decisions and that you have the tools necessary to do that. The best way we can do that is to complete a custom Social Security analysis for you or for you and your spouse. What we'll do is run a series of optimization and maximization scenarios to help you identify your best claiming strategy, whether you're single, married, divorced, or widowed. You'll want to check your email in the next couple of days for the links on how to complete the Social Security analysis as well as the retirement gap analysis. These links in your email will take you to our website where you can complete an online form that will help us gather the necessary information so that we can complete the Social Security analysis for you. Understanding Social Security and how you're going to maximize it is only one piece of the retirement puzzle that we have to solve. That's why we created the retirement gap analysis to help us understand where you're at, where you want to be, and how we get to that point. So you will also be receiving the link to complete the retirement gap analysis. By completing the necessary information on the online form, we will be able to generate for you a report that shows you where you're at, where you're wanting to go, and how to get there. Thanks again for sharing some time with us today. We look forward for the opportunity to help you maximize your Social Security benefits as well as plan your retirement. Thanks again. I'm Adam Jones with Keeler Thomas Management. Have a wonderful day.